All right, welcome back to the Explainer, everyone. If you follow the tech and display manufacturing space, you know for sure that this quarter has been highly anticipated. Now, earning reports can sometimes feel like this endless, confusing maze of acronyms and just incredibly massive numbers, right? But that is exactly why we're here today. We're going to decode those numbers, look past all the dense spreadsheets, and uncover the real story of what's actually happening inside the business right now. Before we jump into the deep end, I want to anchor us with this quote, straight from the company itself. You dream, we display. It's so easy to get totally lost in a sea of financial data and just completely forget that behind every single Korean won on these balance sheets, there's a real company out there actively innovating hardware and pushing display tech forward. This isn't just a story about money, it's a story about the complex, physical machinery of global tech manufacturing. So, to make sense of the KRW billions and EBITDA margins, here's our roadmap for today. First, the Q2 2026 big picture. Second, revenue and profit margins. Third, technology and product mix. Fourth, cash flow and debt. And finally, the road ahead. Okay, section 1, the Q2 2026 big picture. Okay, let's dive into this. Before we get into the granular math, we really have to understand the general market vibe right now. The big takeaway from a broad perspective is that the company maintains solid shipment trends compared to last year, despite typical seasonality. If you've been around this industry, you know that certain quarters naturally hit a lull in consumer electronics demand. So maintaining solid physical shipments during one of those cyclical slowdowns, that's a massive operational win, and it really sets a strong foundation for the financials we're about to dig into. Moving right along to Section 2, revenue and profit margins. Okay, so we've established that physical units were moving out the door at a healthy clip, right? But how did that translate into actual dollars? Or, well, won. 5,612 billion Korean won. Let that sink in for a second. That is just a staggering amount of capital flowing into the business in a single 3-month period. And what's even wilder is that this is actually a bump up from Q1, which sat at 5,534 billion. So, top line, the revenue engine is absolutely roaring and actually speeding up quarter over quarter. But a sky-high top line doesn't automatically mean smooth sailing across the board. Which brings us to the slightly more complicated part of the story. In Q1, the company posted a positive operating income of 147 billion KRW. But then in Q2, bam, that flips to a deficit of 108 billion KRW. It's a pretty stark reminder of the massive costs associated with producing at this kind of scale, and it really shows just how fast operating margins can tighten up on you. Actually, scratch that. It's not all doom and gloom on the profitability front. When we look at the net income deficit, things are genuinely improving. Back in Q1, the net deficit was sitting at a really heavy 576 billion KRW, but here in Q2, they managed to shrink that down to 419 billion. So yes, they are still operating at a deficit, but they are actively closing that gap, which tells us that some of their cost containment or efficiency measures are definitely taking root. And to round out the margins, we have to touch on EBITDA. The EBITDA margin for Q2 is sitting at a very healthy 15.5%. If we look at that in absolute terms, it's 872 billion KRW. This is an absolutely crucial metric because it proves that despite the net deficit, the core operational engine of this business is still throwing off a very significant cushion of cash. Let's pivot to Section 3, technology and product mix. Now, what's really interesting about this is where all that money is actually coming from. You hear display company, and you probably instantly picture massive flat-screen TVs, right? Well, TV only accounts for 20% of their revenue mix this quarter. The IT division is actually doing the heavy lifting here, bringing in a massive 42% of revenue. And that's closely followed by mobile and other applications at 36%. It perfectly illustrates how incredibly diversified their display applications have become in today's tech ecosystem. To back up that diverse product mix, they're leaning heavily on 3 major strategic pillars. The big one is efficient fab management. Honestly, think of a fab, a high-tech display fabrication plant, like a massive, highly optimized commercial kitchen. The goal is to run it so perfectly that you pump out more high-quality dishes with way less waste. You combine that kind of efficiency with securing supply chain flexibility, and their push to maintain global leadership in OLED technology. And you've got a really solid strategy designed to fiercely protect their market share. All right, Section 4, cash flow and debts. We've talked about the products and the revenue, but now we've got to look at the bedrock foundation, the balance sheet. I know. Reading an unedited IFRS statement can literally feel like trying to decipher an alien language. The sheer volume of rows and columns is enough to make anyone's eyes glaze over. But don't worry, we don't need accounting degrees today. We're going to simplify the whole shebang right now. So the crucial point is really the shift from Q1 to Q2. Notice the trends here. Cash and cash equivalents took a tiny dip, going from 1,525 to 1,452 billion KRW. Meanwhile, their physical inventory swelled from 2,787 up to 3,092 billion KRW, and total liabilities ticked upward just a bit to 19,851 billion. It essentially paints a picture of a company tying up some cash by investing heavily in physical inventory, while absorbing a slight tightening in their immediate on-hand liquidity. When we translate those raw numbers into ratios, we get a much clearer sense of their leverage. The liabilities to equity ratio crept up a bit this quarter, hitting 260%, but, and this is key, they are managing their core debt remarkably well. The net debt to equity ratio actually stayed relatively stable, ticking down just a fraction to 156%. So it's a very careful balancing act. They're carrying the liabilities they need to operate at this massive scale, but keeping the actual debt from spiraling out of proportion. And finally, Section 5, the road ahead. We've gone through the shipments, the massive revenue, the tech mix, and the debts. If we were to summarize this entire quarter into one narrative, it's a story of absolute massive scale colliding with structural costs. On one hand, you have this powerhouse generating over 5.6 trillion won in 3 months, backed by cutting-edge OLED tech and dominant positioning in IT and mobile. But on the other hand, they are actively navigating the turbulence of an operating deficit and managing the capital constraints of all that rising physical inventory. Which leaves us with the ultimate question as we look forward. With WOLED technology continuing to advance, will that relentless push for highly efficient fab management actually be enough to cross the break-even point and reverse the deficit in Q3? It is a super high-stakes balancing act of manufacturing efficiency against global scale. And honestly, it's going to be incredibly fascinating to watch it all unfold next quarter. Thanks so much for joining me for this explainer, and definitely keep your eyes on those fab efficiency metrics.